So the Sydney housing markets were a pretty weak result in September, 0.1% growth over the month. I don't necessarily think that that's reflective of what we're going to be seeing going forward. It's still the strongest performing housing market over the year. Values are up almost 17%. You from time to time see these lacklustre results. Our view is that the market in Sydney is probably going to slow from here on an annual rate of growth, but the 0.1% is not necessarily reflective of what we're going to be seeing going forward. We still think low interest rates will support growth in the market. There's still going to be quite a lot of investor activity in the market, but what we're starting to see is the amount of stock available for sales really rising quite significantly. Buyers have a lot more to choose from. They don't need to be as hurried in making their decision. And as a result, that's going to lead to lower levels of capital growth in the market. We're already starting to see signs that people are looking to markets but outside of Sydney and Melbourne, largely the Brisbane housing market, where there's still some capital growth, albeit it hasn't been as strong. You tend to find historically markets like Brisbane and Adelaide follow after Sydney and Melbourne have recorded strong levels of growth. Now, I don't think they're going to surge like we've seen Sydney and Melbourne, but certainly there's a lot more affordability in those areas, and Hobart to a lesser degree as well. But what would really drive more investment and buying in those markets would be a greater level of job creation in those areas and more positive interstate migration into those markets. The population growth seems to be coming in Brisbane, but not so much in some of those other capital cities outside of Sydney and Melbourne. And jobs are really a big factor at the moment when the unemployment rate's already elevated. So Melbourne values rose by about 2.5% in September, and they're up slightly more than 14% over the last year. The annual rate of growth is actually now at its strongest level since late 2010. So there's definitely more activity happening there. It's very similar to Sydney in terms of its fundamentals, strong population growth, good job creation. The main difference at the moment though is, although total stock levels are higher than Sydney, it's not rising as rapidly in terms of the new stock coming onto the market or total stock coming onto the market as what we're seeing in Sydney. So we're not seeing this big influx of new properties hitting the market, and I think that's really supporting the Melbourne housing market at the moment. Of course, the other fact supporting it is it's still a lot cheaper than Sydney, so that's what's going on there. It's not beyond the realms of possibility that in a couple of months' time, Melbourne will actually be outperforming Sydney in terms of its annual rate of growth. I don't think we'll see another interest rate cut this year. The market is expecting that there will be another cut in 2016, and a number of economists have come out and said there could be another cut or two. It is all really dependent on what happens in the broader economy. There's definitely signs that there's weakness in China, and obviously the resources sector is very weak at the moment. So I don't think that a rate cut's off the table, but I think the likelihood probably is that there'll be one more rate cut, if any, and it'll be sometime mid next year.